Welcome to the first webinar of the Machine Learning and Quant Finance webinar series. So today we'll talk about machine learning for interest rates and credit. The work includes a lot of slides that are based on joint research with Alexey Kondratyev of Imperial College. All right, so first of all, we'll be talking today about machine learning, right? And specifically we'll be talking about a specific way to use machine learning, which I would call model learning. Before we go into model learning, I'd like to review what's involved in traditional model selection and then model collaboration, right? So traditional model construction that we've been doing in quant research for the past 4 decades. And then once we review that, I will go into what's different about model learning. All right, so what's involved in traditional model selection? Traditional model selection means essentially choosing a stochastic differential equation for the model. Right. Sometimes there are models called parsimonious models, which actually don't involve any theory for the stochastic process. For example, Nelson-Siegel is one example. It's just a bunch of exponents that fit the yield curve well. But most of the quant models are based on a stochastic differential equation. It's written usually in continuous time. It has state factors, risk drivers, and it has state variables. Now, once you make model selection, it has to be right for a wide range of names. For example, we're talking today about a theory for interest rates and credit, right? So multiple currencies, multiple countries in case of government bonds, multiple credit names in case of CDS. A wide range of risk factor values. The model has to work for low, medium, or high rates. And even if today, let's say the rates are low, but you're building a model for a long time horizon, your model has to work well for future risks, future evolution of interest rates where they can become very high. So in other words, the model has to cover the entire range of risk factor values from low to high, even if today the rates are low, or maybe in a different country today's rates are high. And also, the model has to be good for an extended period of time. And here, extended period of time means not the model time. It means it has to be good for a number of years, because we don't want to be selecting a new model every year, right? We don't want to be saying today our model is, let's say, LMM, and tomorrow our model is LMM Sabre, and next day we're back to LMM, right? So the model has to be good for an extended period of time. Models improve, they change. We don't want to be switching the model all the time. Now, what can can go wrong with this? And things that can go wrong, usually, as we know, will go wrong. First of all, a simple model cannot capture the full complexity of data, but more sophisticated model may overfit the data. Right. So in other words, if our equation is simple, it may give predictions for very high rates, very low rates, very long time horizons that are not reasonable. And we may tolerate it because we would like the model to be simple and easy to calibrate. If we try to become more accurate for edge cases, the model has more parameters. It becomes less stable in calibration. So there is a trade-off here. Right. Now, second thing is market change is gradual, but model switch is not. Right. So in other words, rates used to be mostly log normal, and then they became mostly normal. And the fact that they've been log normal and became normal is not something that we, is not a function of our model selection, right? We can just look at the volatility versus rate level, and we can discover that they have been indeed log normal, and then they became normal. Or for example, SMILE, is changing over time, right? The changes are gradual, but the model change is often not, right? So if we go from log normal model to a normal model, it's a one-time switch, whereas the change that in the markets that happens is a gradual change, and that's a mismatch that is undesirable. And finally, there's a lot of inertia, right? So model may may remain popular many years after, in fact, it stopped fitting the market well. All right, so let me illustrate something that I think is a good example of what we're talking about here. Laws of nature versus laws of financial markets, right? So E is equal to MC square at the level of the atom, or at the level of the galaxy. And also, aside from various theories of the Big Bang and inflation, for the majority of the time of the universe, for billions of years, E was equal to MC square, and these parameters, basically, this is a theory that's has stood the test of time for billions of years. Okay, now, can you spot the difference between the two pictures in the bottom? Right, on the left is London in 1977. On the right is London in 2006, right? Not a lot of difference. However, in 1977, as shown by research of De Guillaume, Pogudin, and Ribanata, I'll talk about this paper more today. Interest rates in the UK look normal, right? We're talking about treasury rates, so not even the swap rates. And by 2006, they became normal. Okay, well, what's the difference, right? It's not billions of years. It's the same country. It's only a few decades. So basically, my assumption is the London Eye did it, right? You see the London Eye here in this picture, but not in this one. So London Eye was constructed, and the rates became normal. So selecting a model is fraught with risk, right? So the model may be good today, and may still, it may not be good tomorrow, right? So is there a better way? Well, we believe that model learning is actually a better way, and model learning is the application of machine learning to the process of model selection and model collaboration, which are rolled in one. Right. So with model learning, latent data representation is discovered by training without preselecting NSD. Right. And the use of machine learning is key distinction from the traditional model-free techniques, because with traditional model-free techniques, and of course model-free calculations are not new. There have been papers on model-free, derivatives pricing, various other approaches for the past decade at least or more. The difference here is that model-free techniques are typically just interpolation. If you are, let's say, pricing an exotic derivative and you're calibrating to vanilla derivatives, sometimes you don't really need much of a model. You only need to interpolate well. And same thing, often with the risk calculations, where historical data may be rich enough to give you enough data such that you can do things like, for example, market risk, right? Which is also, like historical VAR is really a model-free approach. You're just looking for samples in the historical data, and you're making conclusions about future risk from what happened in the past without really model being involved. So, however, once the traditional model-free techniques, they mostly interpolate or use the data directly. And okay, so let me just interrupt for a second. So I see an annotation request. What I would like to do is leave plenty of space for questions at the end. But just to make sure that we actually don't run out of time, I would like, I'll be very happy to allow annotation of content as well as any questions, but I would like to do it at the end. So I'll declare it for now, but please submit this request toward the end when there are questions. And also, I would like to also use this opportunity to stop for a second and say that I have a colleague, Anastasia, who's also on the line. So she will collect questions that are in the chat. And she will, in a separate chat that I have for the organizers, will be able to tell me if there's any question, that needs to be answered directly. So if you'd like to see something, if you'd like me to comment on something during the presentation, so please type the question in the chat, and the team will manage it and send the question to me, and I'll answer it because I cannot be looking at the chat when I'm sharing the screen. All right, so now back to the presentation. Right, so traditional model-free techniques rely on interpolation, and what it means is that they'll make predictions, or they make conclusions. They will get results that are kind of predictable. Right, so in other words, let's say volatility is higher, they'll show more risk. Volatility is lower, they'll show less risk. Now we will show that with model learning, sometimes this obvious prediction is actually the right answer, right? And that's great, right? But sometimes it's not. And I'll show several examples. Some of them are stylized, right? So just we, be able to use them to gain confidence in the model. And others based on real data, where model learning actually does the opposite of what traditional interpolation would do. And we as humans will be able to see that it's right. So in other words, the way that model learning makes prediction from the data is highly nonlinear and non-intuitive sometimes. But once you look at it, you can see that it recognizes a pattern. And I think that's a very important distinction. I'll specifically talk about, kind of a Turing test, right? So we call it a Turing test, where you can see if it's really learning or it's just interpolating. I think it's very important, especially with machine learning, being field, still in its infancy. With machine learning, I think a lot of machine learning models, if you're not careful, they can just end up being very simple interpolation. And this quote-unquote Turing test for model learning is what will help us understand if machine learning is actually doing something useful. All right, so now with model learning, the incoming data is continuously incorporated and allows the model to evolve gradually without a sudden change. Now, the problem that we normally have, both for valuation and risk, in interest rates and in credit, is data scarcity for a single name. What is the name? Name is currency, country, credit spread. I'm not talking about other asset classes today, but if this is commodity, this would be the commodity. If this is equity, this would be the equity name or an ETF. So data scarcity means that for a single name, data is rarely, if ever, covers the entire range of risk factors, and sometimes covers a tiny fraction, right? And in fact, this is the primary reason why we need models, because if we had plenty of data for a single name covering the entire range of risk factors, we would be able to use interpolation and we would not need the model. We do need the model because of data scarcity. Right, so let me give you an example. This is a chart from a paper by De Guillaume, Pagudin, and Ribanata. And in this paper, they've been studying the dependence of volatility on rate level. Now, this paper is actually extremely important because it provides, I think, foundation for how we're going to build a model for volatility. But I want to clarify that what this paper does is not in itself a model, right? So, in other words, it's an input to the model. It's perhaps a guidance to building a model. It's one factor calculation. We have rate, right, which in this case, is a particular, let's say, 10-year treasury rate. Actually, this pattern is observed for most of the maturities. And we're not saying, we're going to build the entire yield curve from this one point on the yield curve. No, what we're trying to understand is that if we're looking at a single risk factor, a rate of a fixed maturity, how does that volatility depend on this level? Is there a pattern? Well, the thing is, you can see here that each point dot here is the volatility obtained by averaging, essentially estimating realized volatility over a year, right? And you can see here that each point is a year, and eventually we get from 1977, when London did not have a London Eye, and to 2006, when by then it did, right? So as you can see, it has been moving toward this line, which is shifted log normal, right? So this is the scaled movement magnitude. This is rate, right? So if movement magnitude is proportional to the rate, it's a log normal law, right? Because the intercept here is not at zero, it's shifted log normal. Here is also log normal, and here's normal. So what they've discovered is that it's shifted log normal at high rates, it's normal at medium rates, and it's log normal, but already not shifted, actually slightly shifted, right? Because the rates could be negative at low rates. But for the pound, by the time that they've been looking at the data by 2006, very low rates did not yet occur, right? For this particular maturity, at least. So we're looking here, but our model has to say something about this part, right? And that's why we need the model. Right, so we have there are some models for the yield curve, right? So Nelson Siegel Svensson is a model that will interpolate between maturities. So it doesn't tell you about where the rates will go. It tells you how to get maturities that you don't know from maturities as you do. There are also models, Sabre, you name it. There are tens of useful models, which will tell you that so if you calibrate it to, let's say, rates around 3%. It will predict what will happen at 10% or at 1%. But it's subjective, right? So it will depend on the model. Any model will make a correct prediction if you use it on a data that you calibrate to. However, it's not always possible. Data scarcity, right? So for a given name, we don't have the data for all levels of interest rates. And that's where essentially our predictions become completely dependent on the model choice and very different between different model choices. So they become subjective. All right, well, is there a way around it? Well, yes. What you can do is incorporate data for other names. Because there is more than enough data, so data for a single name is scarce, but data for the entire group of names, for example, all currencies, multiple credit names, multiple countries, if we're talking about treasury yields. So treasury yields depend on the country, not on the currency. They're different in the Eurozone from one country to another. So there is more than enough data across the entire range of names. But how can it be used? Right. So with traditional techniques, when you use data from multiple names, you usually produce results for the quote-unquote average name. That's normally called proxy calibration. For example, you can take credit data from all of the names with a particular rating and produce with a prediction for a given rating. But in doing so, you will lose the information about the individual name. And again, that's not desirable. If we're doing it for the interest rates, we don't want the model for the average currency, or even for, let's say, G10 currency or G20 currency. G20 currencies are different, right? They used to include Russia, right, which is very different from euro, US dollar, or the British pound. So we don't want model for the average currency, right? We model for the specific currency, where data for this currency, which of course always wins, is augmented by data from other currencies where there are gaps in the data for the single currency. So machine learning is a technique that can use data from multiple names, but generate separate results for each name in a highly sophisticated way, and not just by essentially replacing data with the average where you don't know what it is. Okay, so well, how do we know this? Well, here's the proof, right? So this image on the left is a face, right? It's just one image. And on the right, there is an array of images which are generated by machine learning, by a variational autoencoder, from this one image by relying on a library of faces. And as you can see here, this image varies along two directions: smile or no smile, or smile or frown rather, and mouth open or mouth closed. Now, we didn't have any other images of this one person. We had data scarcity, right? It's just this one photo with a person not smiling, not frowning, with the mouth closed. We also have data for other names, in this case, other faces, other persons, who smile, frown, mouth open, mouth closed, right? So we get the whole variety of data for other names, but only one image for this name. So machine learning was able to generate these faces, and these faces are clearly of the specific person, right? So this is not an average person, right? It's not a stick figure. You can see that that's the same person, right? You can recognize the name. And yet, we've been able to essentially extend, essentially we fill the gaps in the data for a single name, but using data from other names, but without losing the individual nature of our prediction. So machine learning can do it. And, there are a lot of, debate, as always, for machine learning is, how much data is enough, right? And, I think it depends also on your model, what you're doing. And this is a very large library of faces, of course. But, there are maybe less dramatic, but still, very impressive programs that recognize simpler things, sketches, other recognition that can do exactly the same thing with about the same amount of data that you have in a historical time series for multiple names. So machine learning can do it, and we do actually have enough data in our disposal to make it do it. All right, so let's try. Let's see how we can proceed. Right, model construction. Okay, so before we start going to machine learning, which is under model architecture, first we need to figure out, if we don't have the SD, what do we have? Right. So we don't need an SD. We're not selecting it anymore. We're not building it. We don't writing it down. So if we don't have an SD, what do we have? Well, of course, we have our machine learning model. It may be a neural network, or something else, but it has to have what in machine learning is called features, right? So inputs. So what are these inputs? Well, you have to construct them a little bit different. It's similar, somewhat similar to traditional quant model construction, but there are some important differences that I will go over here. First of all, let's start from the definition. So let X of t be the complete set of model state variables at time t, meaning the model is Markovian in X, right? So now the model Markovian, right? So when you say Markovian model, immediately you will, as a quant, I start thinking one-factor model, two-factor model, right? Short-rate model. Actually, no, because it could also be a path-dependent model. Markovian in X simply means that if you have any path dependence, right? So in other words, if your future prediction depends on the past history, you simply incorporate it into the state variable. So I'm not making any dramatic, I'm not restricting our model in any way here. It's just a definition. So in X, we'll incorporate whatever we need to make a future prediction, such that conditional probability of future state variables at time t plus tau, contingent on the initial values at time t, only depends on these two sets of state variables and not on the past history, right? So in other words, we don't need just the probability of a particular risk factor value. In fact, that's useful, but that's not what we need for most calculations, right? We need the probability of future levels of interest rates or the shapes of the yield curve contingent on what the yield curve is today, right? So if we're talking about interest rates, x of t is yield curve today, or as well as volatility if you have a stochastic volatility model. X of t prime is yield curve or the volatility in the future, let's say a particular time horizon tau. If the model is Markovian in X, this probability depends only on these two parameters. So it's two sets of variables, right? So in other words, if our model is one factor, then we have probability that depends on two things, right? The rate in the beginning and the rate at the end. If the model is two-factor, or rather has two state variables, then there's four, right? Two in the beginning, two at the end. I'll talk just to simplify notation. I'll talk about a two-factor model, but the same technique can be applied to one-factor model, or three-factor model, or five-factor model, right? So you can even use each point on the yield curve. All right, now one thing here is that again, so for machine learning we have state variables. It would not be quite accurate to say one factor or two factor, because the word factor applies to stochastic drivers, right? So normally when say it's a two-factor model, it means that it has two linear variables, two linear processes driving it. We don't have the SD here. We don't have linear processes. We should get used to it, right? Because it's gonna feel like you lost something, right? But what you gain is much better. So normally I would say two-state model, but given that two-state kind of sounds a little bit strange, when I say two-factor model, with application to machine learning, it really means two-state. Right. Okay, so now how do we generate samples for long time horizons, or rather not even long time horizons, but rather any horizon longer than the horizons for which we calibrate the model tau? Well, we simply integrate, right? So in other words, if our model is not able to draw samples from the distribution P, but gives us information about it, for example, mean of the distribution, how wide it is, moments and so forth, then we need to take this integral. Right, so if our horizon tau is, let's say, 2 years or 1 year, let's say 1 year, and we're interested in probability distribution for 2 years horizon, 2 years in the future, what we do is that we take the probability from today to 1 year, then integrate all of the intermediate states at 1 year for the probability, multiplying the probability to get to 1 year at that state, and then from that state back to the state that we do want. So essentially, it's an integral of probability density. And this integral, you take it as many times as time steps that you need to get to that time point you're looking for. So this is very, this is actually not that different from the SD. However, one distinction here is that for the stochastic differential equation, it's normally written in continuous time. And quants spend a lot of time and effort trying to improve the calculation so it's fast and it's still accurate approximation of continuous time. Here you don't need it. In fact, you can go continuous time, but you don't have to. In fact, it will be counterproductive because it just makes your model slower and less accurate. You will be essentially making round trip from finite horizons where you have calibration data to infinitesimal horizon and then back to finite. With stochastic differential equation, you have to. With machine learning, you don't. In fact, if you're interested only in one horizon, just calibrate to this horizon, right? If you're interested in, let's say, cash flows which are semi-annual, we calibrate semi-annual, right? So that's actually an advantage. Finally, for generative models, generative models, I will have a slide on it later, but these are models that can that don't give you the distribution probability density, but they draw samples from it, right? So they're able to draw samples from it. In this case, we can just draw samples for 1 year, then starting from that, draw samples for the next year and so forth. So we don't even have to take the integral. Essentially, the model takes it for us. All right, and there are two definitions of state variables that you have, depending on how you think of your model. And the contrast between these two definitions, which I will call first category is the term rate models, and that is the forward rate models, which is in the next slide. The difference between them is determined by how you think of your state variables. So for term rate models, state variables have constant maturity length, not date, and are never retired. So in other words, you have a, let's say, 10-year swap as your state variable today, or the short rate, and 10 years later, it's still 10-year swap. It starts 10 years later, right? And it now ends, 20 years from today, 10 years from that point. So your state variables essentially move along with your time point. And traditional counterparts of this model are actually what's called short rate models. But short rate model is a bit of a misnomer because one factor short rate models, they have one risk factor, or risk driver rather, the short rate, and also one state, the short rate. And of course, there's the downfall of these models because they only can predict parallel shifts of the yield curve, or at least 100% correlated shifts. Now, there are also more sophisticated short rate models, which are multi-factor. These multi-factor models have two risk drivers, right? So two random shocks driving the short rate. And because there are two random shocks driving the short rate, that produces the second state variable. So the state in, let's say, two-factor Holland-White model, or which is equivalently can be expressed as G2 model, or a model such as CR2++. So these are two popular models in this category. The state in this model, there is a freedom of choice of the state, and you can choose it as the short rate. Short rate has to be there always. I don't have time to go into detail, but there is a reason why short rate has to always be included. And one-term rate, for example, the 10-year rate, right? So you can say your state variables are 3-month rate, let's say, and 10-year rate. I'm using these maturities because that's often how Treasury data comes in, and there's a lot of data for these maturities. So term rate models, the traditional counterparts are short rate models. However, these are multi-factor short rate models with multiple state variables that can predict uncorrelated shifts at different maturities of the yield curve. And as you can see here, this probability P that we've been talking about is essentially advancing from R0 as 0, right? So R is the short rate, S is the term rate, let's say 10-year swap rate or 10-year Treasury yield. So this probability P moves us, right, tells us the probability distribution of short rate and term rate at one, let's say, 1-year horizon, contingent on the initial value. And then once we get there, So first of all, so first question, what machine learning algorithms did you use to make predictions? Which ML method would you recommend? Okay, so that's actually a great question, right? So I specifically, so the specific methods were, most of the results were obtained with a, multi-layer feed-forward network, which is actually a traditional autoencoder. That was a discriminative model or regression model. And the generative model was RBM. Normally, I would use variational autoencoder, and we're doing research with Alexey Kondratyev of Imperial College, actually on using both of these techniques. But RBM is actually a good thing about it is extremely robust to. It's very very powerful when you don't have enough data, and we don't have a huge amount of data, right? It's not like we have millions of images. So generative model RBM, discriminative or regression model, feed-forward network. And these are really, I don't believe this necessarily will end up the models of choice, let's say 2 years from now or even a year from now. These are just the simplest models that get these results. However, I would certainly encourage everybody to try other models, and variational autoencoders for the generative seem extremely promising and also capable of making predictions when there is scarce data. All right, so second question, what are the, GitHub repos, okay. So I did, I did a workshop following the WBS Spring conference, and there's a GitHub repo for some of the examples. In the workshop, I covered actually both regression models and generative models, but on GitHub, I only put regression because basically the generative models that were used to obtain the results just run for a very long period of time. So I'm planning to continue developing this repository. And we have this workshop series, right? So please watch for future announcements. This is the first webinar in a webinar series that we're running with WBS, and there will be future webinars, and we're going to have GitHub repo for these webinars. But so far, if you go on GitHub, it's github.com/compatible. Anastasia, can you post the link in the chat? It's github.com/compatible/practical machine learning.
Sure, just a second.
Yeah, and so there are some results there already that I've used in slides today, and we're planning to post more results there, and hopefully not something that you can run for, that you need to run for a day in the cloud. By the way, one thing is the question that I wanted to cover now that I mentioned that some of these models, like RBM especially, take a long time to train. For interest rates and credit names, you don't trade at every moment, right? So in other words, when you calibrate the traditional model, that's when you use your machine learning model. And most machine learning architectures is very fast to use, right? So in other words, they're slow to train, they're very fast to use. In fact, you know that basically they're in your phone, basically identifying face and an image. So they don't require a lot of hardware. So sometimes there is a perception that you go from calibration to traditional SD, from calibrating traditional SD to training a machine learning model, and that's a lot slower. You need the cloud. It takes hours. No, because when you're calibrating traditional SD, that's when you're using the trained model, and you train the model to all of the to a lot of past data, right? You don't train it to the data that you have like at this moment of time. So you do need to spend some time training, and then it's good for extended period of time. So training time is not an issue. The other question was, have you tried using GAN, right? So GAN, generative adversarial network, right? So that's actually the network. We didn't try using it, and that's because at least the popular perception is that actually does require a lot of data to train. So because basically we have the architecture that is a little bit more data hungry, it may work. It just was not our first, because of this perception, which perhaps may be in fact misleading, and it may prove to be a good model. We just didn't try it because we wanted to try models which have the reputation for working well with scarce data. All right, which model we should use for long-term and short-term interest rate forecasting? So again, I would say for the model construction, right? So choosing the state variables to be constant maturity length rates or constant maturity date forward rates. I believe that we're talking about forecasting, right? So I assume that's for the purposes of risk. or investment strategy research, I believe that term rate models work better. Whereas for things like pricing derivatives on specific forwards, like replacing things like augmenting things like Sabre, it's better to use forward rate. So first answer is that it's better to make term rates your state variables, right? So in other words, let's say one rate has to be short, like 3-month rate maybe, and then let's say 10-year rate or whatever, 5-year rate, whatever maturities you're interested in. Now, which model to use, which neural network or machine learning architecture to use? Again, so here there's a choice. At this point, I'm not prepared to say that this doesn't work, this does. I would say that we know that feed-forward networks work. We know that variational autoencoders work. We know that RBM works. And of course, because RBM works, also there is something called deep belief network, which is a stack of RBMs. And that, of course, will work because if a single element of that stack works, then the stack with multiple elements should work the same or better. So I would say I don't think there's anything that doesn't work, or at least that we know that doesn't work today. And I would again encourage everyone to try whatever you're most comfortable with. Okay, recommendation for someone totally new to ML world: where should they start? I would say a great way to start is to, I think, do two things, right? So one, and you have to do them together. You cannot do them separately, or it would not be good enough, right? So first thing, right, which is what everybody does, right? You download, TensorFlow or PyTorch or any other machine learning framework and try their examples. Because building all of this, at this point, there is such a wealth of components there that there's such a flexibility in what you can try. I would say nobody in the right mind, I think, would recommend just building it all from scratch, when you're experimenting. However, I would very strongly encourage building a simple, very simple neural network on your own from scratch, right? In Python or C++. Because only when you do that, you really fully understand how it works. What I found is that, we have, a lot of people coming for job interviews and basically say, well, I know machine learning, right? And basically, once you dig a little deeper, say, well, I ran TensorFlow examples. My professor at Coursera told me, to substitute these lines for these other lines. So I think, I wouldn't recommend building everything from scratch, but I think that you have to build something very, very simple from scratch to understand how it works. And then just go through basically any comprehensive framework, whatever you're most familiar or comfortable with. Just go through the examples across all major neural network types, basically architectures, and also not forgetting so neural network is one thing. The optimizer is also a critical element there. There are sophisticated optimizers, right? So if you just do something simple, you will get stuck in the local minima. So third thing I wanted to say is that the optimizer is just as important as the neural network itself. And it cannot be an afterthought, right? You have to be very diligent with the optimizer as well. So this, probably is all of the advice I can dispense in the format of this webinar. All right, so next question. Since credit and interest rates are memory dependent, did you use any LSTM transformer to learn from the rate data? Okay, so yes, I agree, right? So they certainly, have path dependence. What we did is we only learned from whatever is incorporated into our state variables, which have been essentially points on the yield curve. So most stochastic differential equations you have in quant research, they don't explicitly incorporate path dependence, right? So in other words, you take, let's say, stochastic differential equation, one factor, multi-factor, it could be LMM, right? So it depends on today's rates, right? Well, you can say that path dependence may be incorporated in the volatility, but also if you're looking at historical calibration, it ends up being the average. So I agree that path dependence is important. However, for the purposes that we're using these models, both for valuation, where we're calibrating to market implied volatility, so prices, and for risk, where we're normally calibrating to historical data interested in quantiles. Traditional stochastic differential equations have not been path dependent in the sense that our model variables, you can observe them today and you don't need the history other than to calibrate things like historical volatility or historical correlation. Our approach is the same, right? So in other words, our state variables are, so this is a new way to build the model, but we're very traditional as far as state variables, right? Or what we build the model for. We build the model for the same things as we always have built the models as quants. Rates, interest rates, term rates, or forward rates. And just, because of that reason, we also have the same essentially approach to path dependence, where we use it as an incorporated to aggregate quantities, like for example, historical volatility or historical correlation. All right, next question. If you train your model for LIBOR, will you need to retrain it for CMS rates? Well, I wouldn't call it retrain. I think a model for LIBOR, it just depends on what you. It depends on what the purpose of the model is. So if the purpose of the model is to price simple LIBOR or as derivatives, in this case, you train it to data that perhaps emphasizes where the rate goes, right? The levels of rates, and it's not necessarily emphasizing the tilt. In this case, I'm talking about risk neutral, because with historical, the answer is emphatically no, because with historical you have data for all of the interest rates in a historical time series, and it will produce the correct conditional distribution that you need to correctly estimate the risk of CMS, for CMS trades. When you're doing pricing, if you calibrate, just like with any other model, right? So it's the same answer, basically. I would say probably the simplest way to answer this is to say it's the same as for traditional stochastic models. If you calibrate your models to Bermudan swaptions or callable swaps, if you calibrate your model to swaption, European swaption prices, to the volatility surface, and then use it for a callable swap, you'll be fine. If you calibrate the model to only European swaption prices, and it's a simple model that has one state variable or two, you'll probably be, not, especially with one state variable, you'll not be accurate, and you have to have multiple, at least two state variables, and you have to incorporate some data that's sensitive to the tilt. And in order to do it properly with machine learning, so with machine learning, you can actually also somewhat easier combine historical and market implied calibration. But you definitely will not to do something to price CMS trades correctly. You cannot just calibrate the model for, let's say, callable swaps and use it for CMS with accurate results. However, when you're doing risk, because you're doing historical time series and all of the rates are in it, you should be able to have a single model that's good for all trades. For pricing, you probably just, again, like with traditional stochastic models, you need to be careful and target your model construction to the particular trade type you're pricing. Atom or SGD for the optimizers do you recommend? Okay, so of the standard ones, I would recommend Atom, just because of the way it uses inertia. And there are also, various other, techniques that are very highly powerful. There's a whole field there with various Hamiltonian Monte Carlo techniques. So there is a, tremendous wealth of research there. It's all on GitHub. There are presentations on YouTube. So Atom, I think, is an excellent choice that's available in most machine learning libraries, and it does have inertia, so it doesn't get stuck on local minima, but there is a lot more. What regulator's position on this if used for official valuation risk models? I think it's, as with any models, we have to convince the regulators and auditors to use these models. And I think that I would make a distinction here between regulators being happy with the way that we price and the way that perhaps we do limits, where there is definitely a lot more leeway that is given for the bank to construct its models, right? So in other words, if you have a market practice model in a bank, the regulator should be happy with this model as long as your model validation partner basically tells you that, the firm that's doing your model validation tells you it's within market practice. For limits, again, there's no, there's a lot of, I feel, flexibility on how you produce the model for the limits. However, once you start doing things like, the FRTB, right? So in other words, basically the Basel calculations. So there, I think it's not machine learning. Basically, at this point, internal model approach is considered to be too complex, and as we know, has been canceled for CVA, for example, right? Too complex. So I would say I wouldn't hold my breath until for the regulators to allow machine learning and Basel calculations. I think the whole direction, the tide is turned in the opposite direction, where I think that we may end up basically with standardized for a lot of things. But I would say valuation is fine, limits is fine. Things like insurance reserves should be fine, because these are not the models that regulators would prescribe. The risk weight and so forth, right? And I feel that convincing the regulators and convincing the auditors to accept your fair value pricing is only a matter of time, and I think it will happen sooner rather than later. Actually, I think just before we know it, we basically we're planning to put a model in production already for a client, and they assume that they won't be doing it if they didn't think it would get approved. So I would say it's only a matter of time, and I think it will be sooner than we think. When you mention one-hot encoding, I've read that it's good practice to drop one of the categories of interest. Does it still apply in this space? So I'm not sure. Are you talking about dropout? Dropout is actually is a little bit different thing. But oh, I see. Okay, so in other words, you randomly if you're talking about a technique where you drop some of the samples, from the training set, and then you do it again, dropping different samples. That's a valid technique. Otherwise, perhaps you can clarify, maybe ask to unmute. I'm not sure I understood the question, so perhaps I've answered the wrong question. Have you seen? So let me just go to the next question again. So the person who asked this previous question, if I haven't answered, please unmute or type it in the chat, and I'll try to answer better. Right. So have you seen central banks move to machine learning to inform the decision process and setting monetary policy? I haven't yet, at least not that I know of. However, I think that there is a great potential, and I think that if I had to guess where it would happen, I think it would happen with the replacement for Nelson Siegel Svensson. Because central banks, in setting monetary policy, or generally, for all kinds of purposes, they critically need interpolation for the yield curve, right? Because yield curve is noisy, and in order to make decisions with the yield curve, you need a parsimonious representation. And the leading, or perhaps the only game in town really at this point, is what's called Nelson Siegel Svensson, right? It used to be Nelson Siegel, then Svensson added another term. There is no economic theory behind this, right? There's no stochastic model behind this, right? It's not like Sabre. So Sabre is, perhaps an interpolation formula, but is, rooted, is based on, a theory, right? So here's, a risk factor, and volatility that drives that is also stochastic with the power law. Nelson Siegel Svensson is just a formula with exponents, which just happens not to produce arbitrage. It's what's called a parsimonious model, right? So in other words, it's a simple formula that captures the data and interpolates it properly. I would say that a lot of the techniques that we've been talking about here are directly, really, literally, one for one applicable to interpolating the yield curve. And this is exactly where also you can benefit from data for all currencies by making informed decisions about how to interpolate data for a single currency where the data is scarce. So if I had to guess, the first application of machine learning in central banks in this space, right? So not generally, of course, they may use machine learning for all kinds of other things. But if we're talking about interest rates, I think that the first application will be for the replacement for Nelson Siegel Svensson with the machine learning model, because there you don't have to, in other words, the form that's specified right now is arbitrary. It's a formula. There's no economic theory behind it. And with machine learning, you'll have something that's actually driven by the data, right? So in other words, it's something that is non-subjective. It will be doing what the data tells it to do. And if one day the shape of the yield curve changes in a way that Nelson Siegel Svensson cannot capture well, the machine learning model will be able to. Any additional questions? Can this be applied to cryptocurrencies? I don't see why not. I don't think cryptocurrencies at this point, you're talking about the curve. So one day, when cryptocurrencies become more mainstream and, there are financial markets more developed, perhaps. So at this point, I would say, just, hold for your dear life. If you're interested in modeling them, and enjoy the ride if you can. So at this point, it's just too early. I think not enough data, too volatile, not a curve. But one day, why not? I mean, when they become more mainstream and more data is accumulated, I don't see why not. Okay, you can see that there's another question coming. Let's wait. What is the motivation for using machine learning as a short rate model that captures the normal profile, such as the regime shift short rate model? I think it's a great question. And basically, the motivation is that you don't have to choose your form, right? So in other words, the question was the motivation of using machine learning versus a model that captures a particular log normal profile? Well, because it's markets and it's not exactly that profile, right? So it's financial markets, they're not neat, right? So they don't follow neat laws. So the real profile is not exactly log normal in the beginning. It's not exactly flat in the middle, and it's not exactly shifted log normal at the end. Of course, first of all, there is no broad boundary, right? It's a continuous transition between these regimes. And, maybe 2 years from now or 5 years from now, it will be different. Maybe, it will not be flat in the middle anymore. So machine learning is able to, in a single step, right, which we call model learning, is able to select the parsimonious form and calibrate it. With this parsimonian form essentially becoming what's called a latent model representation from the word lateo, which is hidden in Latin. So the motivation is that the form you've chosen today that fits the data today may not be right tomorrow. It may not be right 5 years from now. And with machine learning, if it's obvious what the form is, it will get something very similar to that form. If the data is clear, tell us, okay, so it's really straight log model, straight normal, or whatever is the law. Machine learning will do the same thing as the models. In this case, of course, there's no use to it, but it's rarely this way in financial markets, right? So you say, well, I start from Black-Scholes and there's a smile, or a smile is not enough, right? So there's stochastic volatility. So in other words, financial markets, unlike physics, defy neat, simple, clear equations. It's always this equation plus some additional tweaks you need to apply to be realistic. So with machine learning, the promise of machine learning is that you no longer have to choose an equation and agonize over whether it's accurate or whether you need to tweak it. And if you tweak it, would you overfit? Machine learning does it for you, and especially if you incorporate it, basically if you use Bayesian calculus to build your machine learning model, it will actually rigorously analyze if evidence suggests that a particular tweak to the model is needed, and will apply this tweak transparently. And then you can look at this latent representation. There are ways to actually expose it and see what it did. And that's makes you sleep a lot better at night compared to choosing an equation and then not knowing if it's still applicable. All right, so that was the last question. So once again, thank you for joining today. Please watch for future announcements. Over to the organizers.